Hi, this is Alex Nunemaker, Mortgage Podcast. Name to be determined, but it's my first podcast. Thank you for listening. Thank you for checking this out. This is going to be a short format podcast reviewing the week in mortgage and real estate news, giving realtors a primer for the week ahead and tips to help their business and their clients, keeping them informed. I'm going to keep everything under 5 minutes so that you learn a little bit without a huge time commitment and you can move on with the rest of your week. So that being said, let's jump right into market news. This is going to be an incredibly volatile rate week. We've already seen that. The consumer price index, or the CPI, inflation numbers came in last week, and that showed that inflation had risen to 8.6 year over year, which was higher than expectations. Investors were hoping that April had represented the peak for inflation. So when these higher numbers came in, that set some fears into the market that inflation won't be stopping anytime soon. Inflation is a natural enemy of mortgage bonds and as a result, mortgage rates. So an important thing to communicate with clients, the Federal Reserve is going to be meeting Wednesday on the 15th. And they're expected to raise rates. And most people think that when the Federal Reserve says that they're going to raise rates, they're directly talking about mortgage rates. They're not talking about mortgage rates, but rather they're talking about the federal funds rate, the rate at which banks lend money to each other and the Fed at the close of business. And that trickles throughout the market, but by raising rates, they're actually trying to combat inflation, which would cool the market and actually be positive for mortgage rates. The key is market confidence. So the Federal Reserve has said that they're going to set out on a course to raise rates on a consistent basis, typically about 50 basis points. But right now, the market doesn't believe that that's enough to combat inflation. So right now, the projection is that the Federal Reserve is going to raise rates by 75 basis points. And where rates are going to head is going to depend upon the market's reaction, not just to the amount of the hike, but to the notes that are coming from Federal Reserve members and if they're buying what they're selling. It's all about market confidence. If they feel like the actions that they're taking are going to be enough to tamp down inflation, we could see some easing of mortgage rates. Key thing for you, if you have anybody on the listing side, anybody looking to sell their home, since October of last year, with the interest rates effectively doubling, the thing to keep in mind is that on average, that stripped away about $120,000 in buying power. Meaning that if I had someone who was pre-approved for a $500,000 purchase, effectively now they can afford a maximum of $380,000 unless they change their finances. So the market's been really resilient. We've seen clients who have said, okay, I'm going to bring on a cosigner or I'll get gift funds, but there's only so many cosigners and gift funds that someone can get before that dries up. So we might have already reached that tipping point. So tell anybody who's looking to sell, that old adage, pigs get fat, hogs get slaughtered. If they've got an offer in hand, if it makes sense, they need to sell. Your mortgage tip of the week. Anyway, if you've ever had anybody who has complained that they're getting harassed by all sorts of marketers and online lenders once they're approved, well, there's a reason for that. It's something called trigger leads, and this actually comes from the credit bureaus themselves. They see a mortgage company pull a credit report, they take that information, sell it to online marketers and say, hey, this person obviously might be looking to buy a home pretty soon. They just had their credit pulled by a mortgage company. They sell that information for a fee, and then online marketers say, game on. They start harassing clients with all these calls. So is it a terrible way to do business? Yes, but it can and does happen. But fortunately, there is a way that they can opt out of that. There's a website where they can opt out of those pre-screened calls. Your client can go to optoutprescreen.com. This website prevents credit bureaus from selling their information as a trigger lead. So if you've had anybody who's frustrated by that, let them know it's not your mortgage company who's selling that information. Far from it. It's actually the credit bureaus. Finally, the quote of the week. Opportunity seldom rises with blood pressure. That's by Jared Kintz. So remember, these are interesting times for sure. A lot of volatility. But our clients are depending upon us to be the calm and informed voice for them. And we can do that. If I can help anyone get pre-approved, reach out to me. This is Alex Nunemaker, your loan officer resource. Have a great week.